Analyzing Business Models. Lecture 2. Lecture Outline. Hello, welcome to Lecture 2 of Equity Master Secrets. This lecture is on analyzing business models. So this is what we are going to cover over the next hour. We'll talk about what it means to invest in a business and define exactly what it is and how that's relevant for value investing. Then we'll talk about the analysis of business models. So how do we look at business models of a company and how do we understand them? How do we analyze them? And in order to analyze business models, we're going to look at a particular framework known as Porter's Five Forces model. And finally, we're going to apply Porter's Five Forces model to two different companies. We'll look at Arvind Limited and Nestle India Limited. And finally, we'll conclude. Okay, let's get started. Investing in a business. The first thing I want to talk about is what it means to invest in a business. Now, the reason we call it investing in a business rather than investing in a stock or buying shares is that when we do value investing, we really want to be in the mindset or in the framework that we are actually investing into a particular business. We are buying into a particular company rather than just, buying and selling shares. So whenever we invest in a stock, we become a part owner of the business. Okay? The way, large corporations are designed is that ownership is diffuse. It is spread out throughout the public. It is spread out through different shareholders. So when we buy a share in a business, we do become a part owner in that business. And we need to incorporate that mindset that we part own this particular business. Now, here's a simple question. Would you ever put money in a business that you don't understand? Of course not. If you're going to invest your hard-earned money into a business, you want to make sure that you are very comfortable with how the business works. You understand exactly how the company works, how they generate profits, and what their future prospects are. One of the main cornerstones of value investing is that we have to understand our business thoroughly. We need to take the time to understand a particular business and then invest only in businesses that we understand well. Now, you'll see a lot of companies which come up with, for example, very complex products, and we may not be fully comfortable with how exactly their products work or how they intend to generate profits from that. And these are situations we want to avoid. Whenever we invest in a company, we want to make sure that we are very comfortable with how the business works. We have to think of it as we are actually parting with our hard-earned money to put it into a business so that the business can use that capital to work and generate returns. So whenever we buy a stock, we need to think that we are actually buying into this business. We are investing into this business. And a precondition for us to invest into any business is that we thoroughly understand how this business works. Analysis of business models. So now we have some idea of what it means to be investing in a business. In order to invest in a business and in order to understand a business, we need to understand a business model. So now we'll spend a bit of time talking about the analysis of business models. Whenever we study a company, we start by analyzing its business model and the industry structure. Before we carry on, let's just talk about what a business model is. A business model is simply the method the company uses in order to generate profits, right? So it's the model that they use, okay, or the method that they use in order to generate returns for shareholders. So when we study a company, the first thing we want to do is analyze the business model of the company. That is, how does the company generate returns? And also the industry structure. So what does the industry look like? A company's business model, as we said, is a description of how a company operates within an industry or economy and creates value for its shareholders. Now let's look at this definition in a little bit of detail. We have two aspects here. The first is, how do they operate within the industry or the economy? So are they a market leader? Are they a small player? Are they a new entrant? Are they an established player? These kinds of questions all tell us how the company operates within an industry. Other questions might be, how do they compete with others? Do they compete on price? Do they tend to compete on brand? The second part of the equation is, how do they create value for its shareholders? So as we said, how does the company generate profit, right? What are the methods the company uses in order to generate consistent returns? Now, when we analyze business models, we're going to use a framework called Porter's Five Forces. And most of this lecture is going to revolve around Porter's Five Forces framework. Now, what Porter's Five Forces framework is that it is a very powerful framework that can help us to analyze a company's business model and the overall industry dynamics. So we're going to spend some time talking about first what Porter's Five Forces is, how it works, and then we'll actually apply it to some examples so that we can understand exactly how to analyze a business model. Porter's Five Forces Basics. Now we will turn our discussion, as we mentioned in the previous slide, to Porter's Five Forces model. In order to build up this model, let's start with some of the basics. So what happens in an industry? Well, the first thing to know is that in any industry, we have firms. We may have one firm, we may have two firms, we may have 4 or 5 firms, or we may have 100 firms. It really depends on the industry that we're looking at. So we have a particular number of firms in an industry, and they compete for profits. Okay? Firms are in constant competition with one another as long as we have more than one firm in an industry. The key point about competition is that it is not limited to direct competitors alone. So what is a direct competitor? A direct competitor is another company that's also in the industry that's also producing at the same time. Other factors that also affect profits are potential new entrants, customers, suppliers and substitute products. All of these factors also impact an industry's profitability. So when we talk about competition, direct competitors, as we said, are people that compete in the same industry, producing a very similar good. The indirect competitors, if you will, would be potential new entrants, people that haven't yet entered the markets, and companies in different industry that may supply products that are similar, right? Substitute products in different industries. So competition is big. Firms compete with a lot of different players in the market. Now these factors we've discussed, so new entrants, customers, suppliers, substitute products, these of course impact an industry's profitability, and we will talk about them in a lot more detail throughout this lecture. What Porter's Five Forces model does is it gives us a solid understanding of a company's business model. Okay, so we try and understand the business model through this framework, right? Through looking at these different factors. This allows us to understand the company's business model. It also allows us to understand the industry structure. So how does the industry work? And finally, and arguably what's most important, is the long-term profitability of a company. When we're analyzing a company using Porter's Five Forces, we ultimately want to figure out, is there potential for long-term profits for this company? Porter's Five Forces Benefits. In this slide, what we are going to do is talk about the benefits of using the Porter's Five Forces model. What are the main reasons we like this model to begin with? Now, as we alluded to earlier, the Porter's Five Forces model helps us to analyze a company's business in the context of the industry in which it operates. When we are analyzing a company's business model, or trying to understand its future profitability, we take into account the industry that it is operating in. So, for example, we need to look at the entire structure of the industry. How do the companies compete in that industry? What are the substitute products? Is there potential for new entrants, etc.? What Porter's Five Forces model allows us to do as well is filter away short-term market trends and understand root factors that affect long-term profitability of firms in an industry. The key benefit really is that we are looking at profitability from a long-term perspective. We are looking at how profitable can this company be, okay, over the long term. And Porter's Five Forces model allows us to do that, and it allows us to ignore a lot of the short-term market trends. As I'm sure you know, when you follow the stock market, stock prices move around a lot in the short term. And as value investors, we are not very concerned with the short-term movement. We are primarily concerned with long-term movement, and as such we are concerned with long-term profitability. And really what we want to end up with, an explanation as to why some sectors command premium valuations while others do not. What we mean by premium valuations is that certain companies or certain sectors tend to have higher stock prices than others. Okay? And we want to find companies that have this because we want to invest in them, and ideally we want to invest in them before the stock prices before the valuation becomes very high. But really we need to understand, why do some sectors and some companies have higher valuations while others do not? And that's what Porter's Five Forces model allows us to do. Porter's Five Forces. So of course you have been hearing now for a few slides about Porter's Five Forces, and we haven't actually told you what the five forces are to begin with. So let's do that now. The first is threat of new entrants. So when we are analyzing a company, we need to think about what is the likelihood that new entrants will come into this market. New entrants, when they come in, usually tend to erode away existing profits. The second force is bargaining power of customers. So here we look at the company's customers, how much bargaining power do they have? The more bargaining power is with the customers, that makes it worse for the company that we're analyzing. The third force is bargaining power of suppliers. So here we're looking at, if a company is buying inputs from its suppliers, how much bargaining power do those suppliers have? The fourth force is the threat of substitute products or services. Here we are looking at, how likely is it that customers will switch to a substitute product? If a company is selling a particular product, are there similar products in the market that customers can easily switch to? The fifth force is rivalry among existing competitors. Here we are looking at, how do competitors in this market or players in this industry compete with one another? Now what we will do is we will actually go through each of these five forces in considerable detail in this lecture, but this is just a nice overview of what Porter's Five Forces looks like. So we essentially apply these five forces to a particular company. We look at all these factors for a particular company, and from there we can form a picture of what is the likelihood long-term profitability of a particular company. Porter's Five Forces diagram. Here what we have is we have a diagram with Porter's Five Forces, and the first four forces we mentioned are the ones in blue, and the last force, competitive rivalry, is the one in the center. So the four forces, which are threat of new entrants, bargaining power of suppliers, bargaining power of customers, and threat of substitutes, all of these factors, they all end up determining the competitive rivalry within an industry. So when we analyze competitive rivalry, we're actually just analyzing the aggregation of these four forces to the particular industry that we are interested in. So this diagram is a nice way to think about how Porter's Five Forces sort of connects together nicely, and how when we analyze a company, we are analyzing all these different factors, and we're coming out with a competitive rivalry, which will ultimately give us an idea of, what is the future profitability of this particular company. Threat of new entrants. Now what we are going to do is we are going to go through the Porter's Five Forces, each one individually, and talk about them. The first one we're going to talk about is the threat of new entrants. So every industry has what are called barriers to entry. Barriers to entry tell us how difficult is it for a new company to enter this market. So if an industry has very high barriers to entry, that means it is very difficult for new companies to enter this market. If they have low barriers to entry, that means it is easier. So when we look at barriers to entry, this determines how likely it is that new firms will enter the market. The threat of new entrants determines how long high profitability in an industry can last. So if there is a high threat of new entrants, okay, that means industry profitability may not be able to last very long. However, if there are very high barriers to entry, then potentially high profitability can last for a long time. So why exactly is this the case? Well, imagine if a company is making high profits. What do you think would happen if we see a company making very high profits in an industry? What will happen is that other firms will then be attracted to that market, right? Other firms will see, look, they're making very high profits in this market. Let's try and get in on the action. Let's enter the market ourselves. And when new people come into the market, when new firms enter, this drives profits lower. That's because the new company will take away market share from the existing company, and also when there are more competitors, prices tend to come down as well, which also leads to lower profits. There are certain factors that actually tell us what are the barriers to entry and how likely is it that new companies can enter. So for example, factors such as high fixed costs, distribution network effects, use of patented technologies, brand loyalty, government regulations, all tell us how easy it is for new firms to enter the market. So naturally, if fixed costs are very high, or if there are very strong network effects, or you need a very strong distribution network to enter, all of these things increase the barrier to entry, make it more difficult for new people to enter. And similarly, if there are patents, if there is strong brand loyalty, if there are government regulations protecting companies in the market, all of these will make it more difficult for new companies to enter the market. Bargaining power of customers. The next force that we're going to analyze is the bargaining power of customers. Customers are the people that buy the firm's product, the company's product, and whether or not they have bargaining power affects the company's profitability. So, bargaining power between a firm and its customers, as we mentioned, can affect the company's profit margins. And how will this work? Well, if customers have a lot of bargaining power, okay, that means they can get good prices for themselves. That means that we'll get lower prices at which they trade at, and this will lower the company's profit. So what determines whether or not customers have bargaining power? Well, it comes down to whether or not buyers are concentrated. So if there is a very small number of buyers, then they are likely to have considerable bargaining power. So why might this be the case? Well, let's imagine an extreme scenario where a company only has one buyer. Okay? Now in this case, a company has no choice but to sell to that one buyer, right? They don't have anyone else they can sell to. So if that buyer wants to only pay a low price, the company will have to accept, right? The buyer has a lot of bargaining power. And one example of this is, for example, military equipment. If a company is manufacturing military equipment, only the government can buy these products, right? So there's only one buyer in that situation. So there certainly are markets where there are a very small number of buyers. And when there are a small number of buyers, they have a lot of bargaining power. Other factors include how easy is it for buyers to switch suppliers. The more easy it is for buyers to switch to different competitors or different suppliers, then the more bargaining power they have. Also, we would look at whether buyers are price sensitive. So if prices go up, do they not buy? Or do they switch somewhere else? And finally, whether they can afford not to buy temporarily. So if they are bargaining with the firm and they don't come to an agreement right away, are they desperate to buy or can they wait? Now, if they can wait, that obviously gives them more bargaining power. And finally, how dependent the firm is on individual customers. So if the firm is very dependent on individual customers, it has very few customers, then those customers have a lot of bargaining power. Vice versa, if the firm has a lot of customers, then individual customers do not have as much bargaining power. Bargaining power of suppliers. The next force we will look at is bargaining power of suppliers. So the supplier, as we mentioned, is who the firm buys its input from. So in this case, the firm is now the customer. The bargaining power between a firm and its suppliers also significantly impacts the company's profitability. So the factors that affect it are actually very similar to the one we discussed in the last slide. They're quite similar to the bargaining power of customers. The only difference is that now the company is the customer, and the supplier is the one selling the inputs to the company. And the same factors that we discussed in the last slide are going to apply here. If there are a small number of suppliers, then the suppliers will hold significant bargaining power. If there are a lot of suppliers, then the suppliers will hold less bargaining power, and the firm will hold more bargaining power. And finally, what's also important is how easy is it for this firm to switch inputs and suppliers. So for example, if a particular supplier increases its prices, how easy is it for the firm to switch to another supplier and buy inputs from them instead? Now, if it is very difficult for the firm to do this, that means that the supplier has more bargaining power. So again, the situation here is that if suppliers have more bargaining power, then it'll be the case that the company's overall profitability will be lower. The more bargaining power the company has, and the less bargaining power the suppliers have, that's good for the company's profitability. And all the same factors that we discussed in the last slide, so in particular, the number of suppliers, availability of substitutes, whether or not firms can, not buy temporarily, all of these factors that we discussed before are going to apply in this case as well. Okay? So bargaining power, both of customers and suppliers, is extremely important, and these comprise two of Porter's 5 forces, and they're really critical to when we're actually analyzing and trying to understand a company's business model. Threat of substitutes. The fourth factor we will analyze is the threat of substitutes. Now, substitutes refers to whether or not the customers can switch to another product. So, a substitute product is something that the customers could buy instead of this company's product. Now, a company faces competition not just from firms in the same industry, but also firms from other industries that have products that offer the same benefits as the company's products. So what this means is that you're not just competing with people in your own industry, you're also competing with others in different industries that may provide a similar product. The threat of substitutes determines whether profit margins can remain high over long periods of time. If there is a high threat of substitutes, that means that profit margins will be lower over time. It's easier for customers to switch to other products. So one such example of two substitute products would be taking the train somewhere or taking a plane. Right? Both are two different industries. Right? One is air travel, one is rail travel, but they provide similar products. Right? They're both getting you from one destination to another. So that's an example of substitute products that are not necessarily in the same industry. The more likely a customer is to switch to a substitute product, the lower the company has to keep its prices in order to attract the customer. So if there's a high chance that a customer will move to a substitute, the company has to retain its customer and it has to keep its prices low in order to do so. And this naturally lowers the profit margins. Now, when a company has low profit margins, it becomes more difficult for the company to withstand external shocks. An example of an external shock is the rise in the price of its inputs. So if we were looking at the airline industry versus rail, price of fuel is a key input. If there was a large rise in the price of fuel, i.e. an external shock, the airline's profitability might be significantly eroded because they're having to keep prices so low. So a high threat of substitutes is bad for a company's long-term future profitability. Competitive rivalry. The final force we are going to look at is called competitive rivalry. And this brings together all of the other four forces and looks at how do companies compete with each other in a particular industry. So when we analyze competitive rivalry, we are looking at the interaction of companies within that industry. Companies can compete with each other in an industry in a variety of different ways. You could have a lot of price competition. You could have more brand-based or quality competition. There are lots of different types of competition. So one thing that we are quite interested in looking at is, do companies compete heavily on price? That is, do they try and outdo each other by continuing to offer lower prices? If companies compete heavily on price, then this results in lower profit margins overall, right? Because when prices go down, profits go down. Makes a lot of sense. So when is it likely that we're going to have heavy price competition? This is going to occur primarily when companies have very similar products. So if companies have extremely similar products, then we will end up in situations where they will compete heavily on price. On the other hand, if we had significant branding differences or different types of products, then there would be less price competition. So when we have differentiated products, when brand loyalty is very significant, then competitive rivalry is lower. Then we have lower price competition. And in this case, firms are competing primarily on brand. And when firms compete on brand, this allows them to keep prices a little bit higher. So another thing that keeps competitive rivalry low is exit barriers. If exit barriers are low, then competitive rivalry is also low. Right? So exit barriers looks at how easy it is for a firm to exit the industry. So all of these factors come together and affect look at how do companies compete with one another. And all of these factors ultimately tell us what is the long-term outlook for a company's profitability. Applying Porter's 5 forces. So now we have talked about all of the 5 forces individually and in considerable detail. We are nearly halfway through the lecture. The second half of the lecture is going to focus on examples. So we are going to apply Porter's 5 forces to a couple of different companies and analyze them and analyze their business models. So we have selected 2 companies to analyze for the rest of this lecture. We will look at Arvind Limited and Nestle India Limited. These 2 companies are quite different, and they are very different profiling as per Porter's 5 forces model. So that's why we've selected 2 quite varied examples. We have performed this analysis as of June 2013. So whenever you view this lecture, it may be close to this date, it may be further on, depending on when you've signed up for this course. So keep in mind that we have done this analysis as of June 2013, and things do change. Things can change afterwards. However, given that this is a long-term analysis, a long-term outlook, it shouldn't be too much of a problem. Now, where do we get our information? Well, we primarily get our information from company websites. So if we go onto companies' websites, there's a lot of information of how they operate, what their business models are like. We look at annual reports. Annual reports are very important, very, very useful. We'll talk about and look at some annual reports later in this course. Annual reports have all of the company's financial statements, as well as analysis on companies' earnings outlooks and profitability outlooks. Finally, we use data providers that give us information about the company's stocks and earnings releases and various other things. And we use all of these different sources in order to come up with the information that we need. And one of the things to keep in mind is that all of this information is publicly available. So we use public information in order to analyze these companies. And that's something we have to do. We don't necessarily have access to private information, so we have to do our analysis based on the information that is accessible to the public. Arvind Limited. So first example we will look at is Arvind Limited. Now before we go on to analyze the business model, let's just look at the company as a whole and see what they do and what their overall picture looks like. So Arvind Limited is the world's 4th largest denim manufacturer. So denim is the material used to make jeans and is also used for other items as well, but that's primarily where you'll most easily see it and recognize it. They are also India's largest denim exporter. So they export denim materials to other countries around the world, and they are the largest in India to do this. They have a lot of capacity, so their annual capacity in terms of length of fabric is 110 million meters of denim and over 72 million meters of shirting fabric. So these are very big numbers, and this is just to tell us that the company is in fact quite large. They operate in the garment industry, and they have vertical integration within that, so they handle many aspects of the garment supply chain. They have a strong brand franchise and a very wide distribution in branded apparels. All of these factors have placed the company in a strong position, both in domestic markets here in India and global markets, as they also are exporters. So essentially, we are looking at a denim manufacturer that has a very good distribution network that's very, very large, and we want to analyze this business using the Porter's 5 Forces framework. Okay, so let's go ahead and start to do that. We'll talk a little bit more about the company, and then we can actually start to apply Porter's 5 Forces. Arvind Limited. Let's talk a little bit more about this company. So some of the brands that you might recognize that come from Arvind Limited are in-house brands like Flying Machine, Excalibur, Newport University, and Ruggers. So these are some common brands that you might recognize. They also have plenty of licensed brands, which are also very big and very well known. So some of these licensed brands include Jeffrey Bean, Cherokee, L, US Polo Association, Arrow, Izod, Energy, and Gant. They were also a master franchisee of Tommy Hilfiger through a joint venture. And Tommy Hilfiger, as we know, is an extremely large clothing brand. And some of their clients include, they have business-to-business clients, which means they make denim for other clothing designers and retailers. So some of their business-to-business clients include brands such as Miss 60, Diesel, Gap, and Zara for the denim. So as we can see from this picture, Arvind Limited is a big company. Okay, there are a lot of different brands that originate from this company, a lot of brands that are quite popular and that we know quite well. And so, this hopefully paints us a good picture that they are in fact a large company with a lot of reach, and potentially they have a lot of potential to do very well given their strong brand position. But we will look at that in more detail a little bit later on. I want you now to think about, given all these factors, what do you think the outlook for this company is, right? What do you think the long-term outlook for this company is? And think about it as we go through the lecture, and you might be surprised by some of the things that we come up with. Arvind Limited. Now in the last slide, we painted this picture that this company was very big and very large. So perhaps that should translate into them being very, very strong on the stock market. But what we'll see is that that's actually not the case. So despite having a leadership position in the denim industry, Arvind Limited has failed to create value for shareholders. So To see this, good evidence of this is that Arvind Limited was once a large cap stock. They were part of the BSE Sensex from 1996 to 1998. And since then, the company has consistently lost value. So despite the fact that they have such a strong brand and such a strong position in this industry, they have consistently lost value. And today, Arvind Limited is in fact a mid-cap stock. So we would no longer classify it as a large cap stock. Instead, it would be classified as a mid-cap stock. And we really want to spend some time now understanding why is this the case. Okay, why is it that a company that on paper looks so promising has actually performed quite poorly in the stock market? And we're going to use Porter's 5 Forces model in order to analyze the adverse dynamics of the textile industry. Essentially, it comes down to the way the textile industry works and how the way this textile industry works, how it impacts the company's long-term profitability. Okay, so we've now spent enough time discussing the company itself and the summary of what this company does and what their stock has done. Now what we are going to do is go ahead and apply Porter's 5 Forces model, and we'll look at all of the individual forces on this particular company. This will help us understand why it is the case that Arvind Limited has not performed very well. Arvind Limited, Porter's 5 Forces. Now that we have had a chance to look at Arvind Limited, the company as a whole, let's now analyze its business using the Porter's 5 Forces framework. So the first thing we want to look at is the threat of new entrants, and that for Arvind Limited is very high. Why is this the case? Well, first of all, denim is a highly commoditized product. It does not require a lot of capital investment. What that implies for the industry is that it is easy for new entrants to come into the market. If you do not require a lot of investment, then a lot more new players can come into the market. This makes it easy to take away market share from existing players. And in addition to denim, if we even look at apparel retailing, that is the selling of these clothes, the threat of new entrants is also very high. If we think about the clothing market, we'll see that there are so many different brands out there. There are lots of Indian brands, there are lots of global brands, and they all are competing with each other and all at different price points. So you have expensive brands, you have mid-level brands, you have cheaper brands, and among all of those, the competition is very, very strong. So for Arvind Limited, we would say that there's a high threat of new entrants. And this means that longer-term profitability becomes more difficult to sustain. As we mentioned earlier, if there's a high threat of new entrants, when profits go up, new people come into the market, they take away market share, and ultimately drive prices lower and profits lower. So that's the first force we're going to look at. Now let's carry on to the next. Arvind Limited, Porter's 5 Forces. The first force we looked at was the threat of new entrants. The second force we are going to look at is the bargaining power of customers. And based on our analysis, for Arvind Limited, the bargaining power of customers is very high. Let's see why this is the case. So really, it comes down to the fact that there's a lot of competition in this industry. So given that there are several players in the denim space, starting from those selling unbranded items and lower price items, and across the entire range going up to higher priced items that are branded, the bargaining power of customers is especially high in the mid-market segment where Arvind operates. So Arvind tends to be in between the low end and the high end, so they tend to be in the mid-market segment, and in this situation the bargaining power of customers is quite high. So why do we say that this is the case? Well, it's primarily because there are so many other options. Arvind is competing with so many other companies, and as a result, those who are buying clothes from them have a lot of choice. They can buy from different companies if they produce it cheaper. So in order for Arvind Limited to keep their customers, they have to continually offer lower prices, and the customers as a result have a lot of bargaining power. So again, we can see with this force as well, Arvind Limited is in a worse position. This type of force means that its overall profitability is lower over time, because the bargaining power of its customers is quite high. Arvind Limited, Porter's 5 forces. So far we have looked at 2 forces. We've looked at the threat of new entrants, and we've looked at the bargaining power of customers. Now let's look at the bargaining power of suppliers, which is the 3rd force. And again, with the bargaining power of suppliers, the suppliers tend to have a lot of bargaining power. So remember that the suppliers are the ones that sell their inputs to Arvind Limited. So in this case, Arvind is the customer and they are buying their inputs from suppliers. So let's see why we think this is so high. First of all, the main inputs that Arvind needs to buy are cotton and power. These 2 inputs together comprise around 40% of their manufacturing expenses. So this is a huge amount, so this is probably the 2 biggest things they need to buy. Unfortunately for Arvind, when it comes to buying these items, they have very little bargaining power. The entire bargaining power is on the other side, of the supplier side. So when it comes to cotton, they are entirely at the mercy of cotton prices on the global markets, and cotton prices have been quite volatile due to shortages, and this means that suppliers' bargaining power is very high. They can charge what they like, and Arvind has no choice but to pay it. Finally, the bargaining power of foreign licensee companies is also very high. So when they are buying licenses from foreign companies, they also have a low bargaining power relative to the supplier. So really, if we look at the things that Arvind needs to buy, so we've talked about cotton, and even if we think of power, they have to more or less accept whatever prices are given to them when it comes to power. They don't really have any bargaining power there. So all the bargaining power for their inputs tends to rest with the suppliers. And this is another factor that goes against Arvind Limited and reduces their overall long-term profitability. Arvind Limited, Porter's 5 forces. So now we've talked about the 3 forces: threat of new entrants, bargaining power of customers, and bargaining power of suppliers. Let's now move on to the threat of substitutes. And here we are looking at what other products are available that can be substituted for Arvind's products. And in this case, we also conclude that the threat of substitutes is very high. Firstly, there are a lot of other fabrics that can act as a substitute for denim. So if denim were to become very expensive, then customers could easily switch to other fabrics. And the demand for denim tends to move as per fashion trends in global markets. And this can be kind of unpredictable. Fashion trends can move one way towards denim, and they could easily next year move away from denim. And because there are so many substitutes out there, Arvind Limited faces this problem. So because of these 2 factors, we would conclude that the threat of substitutes for Arvind Limited is very high. And unfortunately for the company, there's not much they can do about this. They are very much at the mercy of what global fashion trends are doing, and the fact that there are a lot of other fabrics that can work as good substitutes for denim. Arvind Limited, Porter's 5 forces. So now we've talked about the first 4 forces. Let's now move on to the final force. The final force is competitive rivalry. And here we are really looking at how does Arvind compete with other companies in this industry? How does competition tend to work in this industry? And what we conclude from our analysis is that the competitive rivalry in this industry is definitely very high. Let's see why this is the case. First of all, there exists a huge unorganized market for both denim and shirting in India. Because of this unorganized market, it means that there are lots of different clothing types available from many different companies, and as a result there is a high level of competition. In each of the product segments, there are other players that compete both in the premium end space as well as in the economy space. So whether we are looking at high-end, more expensive clothes or cheaper clothes, in both situations there is high competition between different companies. So as a result, the competitive rivalry is very high. And what tends to happen in this type of situation is that if there is an apparel manufacturer, like Arvind Limited, without strong brand recall amongst customers or without a strong retail franchise, they have very little pricing power. So because of this fact that there's so much competition, and if they do not have such a strong brand presence, then the company has very little pricing power. And this results in a high competitive rivalry across the industry. So now we've looked at all the 5 forces, and hopefully this can give you a good idea of why Arvind Limited stock has performed so poorly. So even though the company is very large and they have a global presence, and based on these factors alone, we might expect them to earn very strong returns over long periods of time. If we actually look at using the Porter's Forces 5 Forces framework, look at this company and analyze it, we will see that all of these 5 forces tell us that this company should not be earning strong returns in the long run, right? Because of all these different factors we've discussed. So looking at threat of new entrants, bargaining power of customers, suppliers, substitutes, and competitive rivalry, all of these factors together point to Arvind Limited not being able to sustain a competitive advantage over time. Okay, and this is exactly what we have seen in the stock price. The stock price has not performed well, primarily because of these 5 forces. So that's Arvind Limited. Now we'll move on to talk about our second example, which is Nestle. Nestle India Limited. So for the remainder of this lecture, we will move on to our second example of Porter, where we're going to use Porter's 5 forces to analyze a company. And in this example, we're going to talk about Nestle India Limited. Nestle is, as you know, a big company. I'm sure you've seen its products everywhere. Let's first talk a little bit about what this company is like and what are the main features and characteristics of this company. So first of all, Nestle India is the Indian arm of the Swiss multinational corporation Nestle. So Nestle is a very big global corporation, a global multinational, and Nestle India is the Indian arm of this company. Nestle is the largest food company in India. Okay, so as you know, food is obviously a product that everyone consumes, so the food market is certainly very large, and Nestle is the biggest player in this market. They are the 3rd largest FMCG company in India, and this is fast-moving consumer goods. So we are looking at companies where they produce consumer goods, and the turnover of these is quite high. So they are the 3rd largest in this regard. They are a leader in branded processed foods. So they create a lot of foods which they put their brand on. These are processed foods that you can usually consume fairly easily without without making too many adjustments to them. So they are a leader in this particular market. And where exactly is this? Does this see itself? Well, if we look at products such as instant coffee, weaning foods, instant foods, and milk products, all of these are branded foods, branded and processed foods that you can consume usually right away. They have a very large market share in these products. And this is where Nestle India has made its mark. And let's go on to continue to discuss the company. Nestle India Limited. Let's now continue our discussion on Nestle India. And first we talked about what the company does. Now let's look a little bit at the company's financial performance. So over the last 18 years, Nestle has been one of the best shareholder wealth creators. Over that time, their return from holding their stock has been around 2,300%, which translates into a 19% compounded annual growth return. So this is very, very good. This is very high, and something that is one of the best in terms of Indian stocks. So what is their main methods for achieving this? Well, Nestle is a low capex model company. That means their capital expenditures are low. And with a low capex model, they also have excellent return on capital, which means their returns on capital is very high and very good. So how can we see this in the evidence? Well, for the last 20 years, or nearly the last 2 decades, Nestle has paid out on average 76 out of every 100 rupees of net profits as dividends to shareholders. And this is very large, this is very sizable. This means that Nestle is paying out around 3/4 of its profits to its shareholders, And this is one reason that shareholders have earned such an excellent return from holding Nestle stock. So how has the company managed to do this? Well, that's what we want to spend the next few slides talking about. Now, what we know so far is that what Nestle does, we know that they make processed and branded foods where they have a very large market share. And we know that their stock prices has performed extremely well. So we want to know, why is this the case? Right? How has the company been able to sustain such strong returns over time? So we will now use Porter's 5 framework analysis in order to answer this question. Nestle India, Porter's 5 forces. Now what we will do is analyze Nestle India using the Porter's 5 forces framework. Let's start with the threat of new entrants. So based on our analysis, the threat of new entrants for Nestle India is quite low. Let's see why this is the case. So first of all, launching a food product is relatively easy. As you can imagine, it doesn't necessarily have very large capital costs, but making it a success is actually based on brand presence. So the main reason Nestle is so successful is because its brand is very, very strong. So although new entrants could easily create a food product, for them to get the brand recognition would be very difficult. And for this reason, the threat of new entrants is quite low. And why is it the case that new entrants would have a tough time? Well, when it comes to brands, brand equity is built up over a long period of time. It takes a long time for a brand to be established and for customers to have trust in that brand. So because it takes a long time to do this, Nestle has this strong competitive advantage over any new person coming in. In addition, Nestle also has a robust distribution network. This ensures that its products are always available and they are available everywhere. And this again would take this is something that would take a long time for a new competitor to develop. So because Nestle has been around for such a long time, in fact it's been around for 100 years, and it's been around for a long time, it has a very strong brand, these two factors mean that it enjoys a definite advantage over its entrants. So newcomers do not have this brand power, and as a result, they will find it more difficult to compete with Nestle. So based on these factors, we would conclude that the threat of new entrants for Nestle India is in fact low. Nestle India, Porter's 5 forces. First, we discussed the threat of new entrants. The second force we will discuss is the bargaining power of customers. Based on our analysis, the bargaining power of customers is moderate. Let's see why this is the case. So in mass segments where volumes play a major role, customers do enjoy bargaining power. Customers also benefit in well-penetrated and mature product categories that are relatively more price sensitive. So this means that if customers can easily switch to another product when prices go up, then they will have more bargaining power. However, for Nestle, except for instant noodles, the majority of its company's products are in the premium categories. So in the premium categories, there is a little bit less bargaining power for customers. So when we look at lower price items like instant noodles, in these situations the customers may have bargaining power because their volumes are high and they are very price sensitive, right? Because it's the lower end of the market. But in the premium categories, this is not the case. In the premium categories, it would be the case that the company's products, the customers do not enjoy that much bargaining power. So across all of Nestle, in some cases customers have bargaining power, considerable bargaining power. In other cases they do not. So overall we would conclude that the bargaining power of customers is moderate. Okay, there are some price sensitivities, but it's not that high. Nestle India, Porter's 5 forces. So now we have looked at the first two forces, okay, which is the threat of new entrants and the bargaining power of customers. Let's move on to the third force, which is bargaining power of suppliers. Based on our analysis, the bargaining power of suppliers is fairly low. Let's see why this is the case. Well, if we think about what Nestle's inputs are, it's making food products, and there are not really any major suppliers of these inputs. So in terms of who they buy their inputs from, there are not very, very large, big suppliers of the inputs for Nestle. They tend to have a lot of smaller inputs from lots of smaller companies. Because this is the case, the suppliers have fairly low bargaining power. In general, if the suppliers are big, okay, then they will have a lot of bargaining power. But in this case, since we do not really have any major suppliers of inputs, the bargaining power of suppliers is fairly low. And this is something that definitely works in Nestle India's advantage, right? The fact that the bargaining power of suppliers is low means that if there are, external shocks that affect the price of their inputs, it's less likely that these will be passed on to Nestle themselves. Okay? So that's what we would conclude by analyzing the bargaining power of suppliers. Nestle India Porter's 5 forces. Let us now move on to the fourth force. The fourth force is threat of substitutes. Based on our analysis, we conclude that the threat of substitutes is low. Let us see why this is the case. So one thing to note is that it is the case that most food products do have readily available substitutes, right? So if you're buying a particular food product, there's usually something else you can substitute it with if you want to. However, people are also creatures of habit. When it comes to food, a lot of people do not like to change their habits and tend to change them very, very slowly. So because of these habits that are deep-rooted, even when new products come out onto the market, most people don't tend to switch. They tend to stick with what they know, and if what they know is Nestle, then they will tend to stick with them. So for example, if someone prefers coffee over tea, or they prefer instant noodles over another snack, they're unlikely to give up these preferences. They're unlikely to move to these other products, even if there's some price differences between them. So this keeps the threat of substitutes for Nestle fairly low. So both of these factors mean that the threat of substitutes is low. Even though substitutes exist, right, there are other food products you can buy, people will be reluctant to switch to them. And that's precisely because people are creatures of habit. So there's a big difference if you think about this versus fashion. When it comes to fashion, when we're looking at Arvind, people switch fashions quite easily. They buy new clothes frequently, right? They can buy new styles frequently. When it comes to food, people like habit. They like to drink a cup of coffee or a cup of tea every morning, or they like to have a particular snack, very regularly. So these factors mean that when it comes to food products and when it comes to Nestle, the threat of substitutes is low. Nestle India Porter's 5 forces. The final force we will look at is competitive rivalry. Based on our analysis, the competitive rivalry in this industry is low, and this obviously bodes well for Nestle. Let's see why this is the case. So if we look at the product categories such as noodles, chocolates, milk, and milk products, in all of these industries, competitive rivalry is fairly low. And that's because brand value in these industries is very strong. So people tend to compete on the brand rather than by lowering prices. Because Nestle has a dominant market share in all of these categories, the competitive rivalry as a result becomes low. We mentioned that because of the brand value, it's difficult for new entrants to compete. As a result, Nestle is able to retain their dominant market share and able to continue to make strong profits. So one such example, if we look at instant noodles, Nestle has a market share of 80%. That's huge, so that's almost nearly a monopoly in terms of this particular market. So as you can imagine, there's not going to be that much competition in these markets. They don't face huge amounts of competition. Even if we look at other categories like baby food, instant coffee, and other milk products, Nestle is again the market leader in these products. They are the biggest, and as a result, they have the competitive rivalry in these industries is low. So now we have looked at all of Porter's 5 forces for Nestle India, and we should hopefully get a good picture of why it is the case that Nestle India has performed so well. By using the Porter's 5 forces framework, we are able to see that Nestle India is a company where a lot of these things work in their favor. So the threat of new entrants is low, the bargaining power of customers is moderate, the bargaining power of suppliers is low, the threat of substitutes is low, and the competitive rivalry is low. All of these factors work in Nestlé India's favor. And this is why Nestlé has been able to earn such strong returns for its shareholders over such a long period of time. Conclusion. Now we have reached the end of our lecture on understanding business models. So let's recap a bit of what we've learned. Understanding businesses, as we have pointed out many times, is fundamental to value investing. In order to be successful at value investing, we need to thoroughly understand the business that we are investing in. Porter's 5 Forces is a powerful framework that allows us to analyze business models and industry structures. Whenever we are interested in analyzing a new company, we will use Porter's 5 Forces to get a good idea of what this industry looks like and what the company's likely competitive advantage is in these industries. So what were the 5 forces that we looked at? Well, we looked at the threat of new entrants. That's the first force. The second force is the bargaining power of customers. The third force is the bargaining power of suppliers. The fourth force is the threat of substitutes. And the fifth force is competitive rivalry. So in the first half of this lecture, we talked about what these forces are and what they mean. And in the second part of the lecture, we looked at examples. So we were looking at how do companies rank on the 5 forces and how this impacts their long-term profitability and shareholder returns. So what we saw was that when we looked at Arvind Limited, though they were a very large company with a lot of market share, when we analyzed it through the Porter's 5 Forces framework, we found that the company is actually not in a good position to earn strong returns over time. And as a result, that has been exactly the case. Their shareholder performance has been poor. And when we looked at Nestlé India, it was the opposite case. In that situation, the 5 forces pointed to a strong competitive advantage for Nestlé. And this is borne out in the shareholder returns. Shareholders have earned strong returns from Nestlé India. So hopefully now you should be in a good position where you can apply Porter's 5 forces model for yourself. So if you are interested in analyzing a company and you want to better understand its business model and understand can this business model earn strong returns over time, now you know how to do it. The next 2 lectures are on identifying economic moats. In the 2 lectures that follow this, we will build up a lot upon what we've done in this lecture. So looking at Porter's 5 forces, but we're going to focus on identifying economic moats. Economic moat means a competitive advantage for a company. So what gives companies a competitive advantage or a moat? And it'll very, very much build on what we've done in this lecture. And we'll go into a lot more detail of how to identify these moats and further understand companies' business models. Okay, thank you very much, and we'll see you next time.